Alrighty, so what we're going to do is the quick risk disclaimer. Carefully read, everyone. It's very important. Any advice in tonight's session is of a general nature only. Your personal circumstances have not been taken into consideration. So carefully read, and once we are ready, we will hand it over to Jens.
Yes, hello
Thanks,
also
Jens.
from my end. And here is the agenda of the first session, so the first hour. And I will start with something I was thinking about. Do I just want to go through the presentation? Because over the years, I realized something which is quite common and very interesting. So there have been plenty of events over here in Germany, but I've also seen the same in the English-speaking trading community. Where I was invited to do live trading events. And it was the German DAX 30 in this case, for example, so European market opening, US market opening. And so we traded the market opens. And what's very interesting is that the main focus from the people, naturally, is on how to enter the trade, where do you place the stop, and what's the strategy behind this, and what results do you like to come to the conclusion that this is a strategy to trade here? So what are the risk parameters beside, or the performance statistics and all that? And what's very interesting now is the following, that after we entered the trade, and the trade is then entered, and the market moves or it doesn't move, and the stop, the trade reaches the stop or the take profit level, that then the rate or the number of attendees drops significantly once we switch over to the, let's call it, review process, and to the theoretical part, and focusing on topics like risk money management, respectively, on trading psychology, but especially when it comes to risk money management. And that was fairly interesting, to be honest, to realize. And this happened over and over and over again. So first of all, I thought it's probably a coincidence. But then over time, I realized this behavior over and over again. And I came to the conclusion, or I tried to explain this behavior. And I said, well, probably this is because of this topic, risk money management, making an overall dry or lame it's some kind of not that interesting, not that exciting when it comes to trading. And so before we start and go through all these points here, I'd like to show you something I prepared now before I started, or before in the morning here over here in Germany. Let me just get this over here. And I just want to show you the motivation, the real motivation, why this is such an important topic and something to not underestimate. In trading, we could say what we are after is to make good decisions. That's what trading is about. And so in this context, in the morning, by the way, John also forwarded me already an email with a question from someone asking what are performance numbers you can expect. And we will use much of this input here. Before we can do this, we need to introduce and define certain aspects, like what is the risk-reward ratio, especially what's expected value, what's the payoff ratio, and all this. We have to introduce this first, and then we can go over these performance statistics, what you can expect. But the thing is that this question, while we could easily do a webinar on this alone for 1 hour and talk about what can we expect and what does this depend on and all this, the thing is that this is something which already shows the result orientation. And so why is this of importance? That's especially important from a trading psychological standpoint. But in trading in general, what you will find out is that most of traders, especially professional traders, profitable traders, do not necessarily trade for the money, but they trade for the overall development process they can go through. And the money itself is just a side product. That might sound ridiculous to some. Might say, well, if you trade, you trade for the money. No, don't get me wrong. I mean, I also trade to make money trading the markets, and I hated to lose, to be honest. But still, over the years, I realized that the focus on the result itself is counterproductive when it comes to the overall success in your trading, because in trading there's luck involved. So sometimes you can enter the market and the market moves in your direction for whatever reason. You enter a trade based on a signal, and then a central banker just announces this and that, and the market goes crazy on the upside or crazy on the downside, whatever, and your trade reaches the take profit. The same is true on the other side of the coin. Once you enter a trade and the market moves against you, even if you followed your rules religiously, you can easily see a losing trade happen. So luck is definitely a component which is involved. And once luck is involved, we can say you should focus on the process and you shouldn't focus on the result itself. So looking at performance and risk statistics is something which is important, because it gives you some kind of framework and some kind of psychological stability, which we will see why it's so important in the second part of this presentation. But still, I'd recommend you, once you start trading, to really focus on the process itself, and to focus on the process and to follow a loop which brings you forward in your overall program or process in this context, and in your process to become profitable trader. There's usually, we can call this a three-step way how to do that. And now the interesting part, and let's come back to this interesting development around risk and money management and people leaving a webinar because this topic is not as exciting as looking someone over the shoulder who says he's a professional trader and trades the DAX, ASX 200 or Australian dollar, whatever, on the long or on the short side. The interesting thing now is that this process here is 3 steps. It's plan the trade. So there's lots of preparation involved. So when I do such a webinar, such a live trading event, in fact, it's only execution, the execution only mode, if you want, once we start the webinar and do the trading. Everything else went already into the preparation, my thought process. What do I want to see? Where do I see the market today, for example? And what are potential catalysts which could drive the price action in my direction? Where's my advantage currently? What are hot news? Is the market I trade is hot, or do I need to look for another market, for example? So this is all what goes into the preparation. Beside of that, there's also psychological aspects which go into the presentation preparation. So like, visualize the trade, calm down, breathing techniques, for example. By the way, risk and money management. Well, how much risk do I plan to take here? So I have a daily stop loss level, for example, stop loss limit. And I say, now I'm willing to risk for this setup here, let's say 20, 30% of my daily stop for this one setup. And then I have to calculate based on what I want to see. For example, how much risk am I willing to take for this trade? How does this equal in your position size, for example? All this is preparation. And then the second point, this is when the webinar starts, it's trade the plan. So this is pure execution. It's execution only mode. And you just enter your order and you just go for it, long or short, whatever. And then the interesting thing is, and this is where the third part comes into play, and why I focus on that is because I personally think, and based on my personal experience, I know that this is true, at least for me. The third step here in this process-oriented thing we are following here, this framework, is the review and tweak part. And review and tweak means here, what information do I get out of the trade? Let's look at the trade again. Does it make sense from a risk-reward perspective, for example? Do the results here mirror my overall trading so far, trading this strategy, for example? Were there any kind of news which affected the trade, whatever? How does this affect, or did this affect my overall risk money management plan for the trade? Was there slippage in the trade? So better or worse execution of your trade, for example. And the thing now is, and that's why it's so important to focus on risk and money management, but also what you can learn from this, also based on your personal feelings, on your expectation, for example, and what you can do to stay calm, for example, in terms of what can you do to prepare better for the day, to stay mentally stable during the day. So risk money management and trading psychology, you have to really be an expert on this, and to fulfill this step and really make this something which works for you. So the review and tweak step here is probably the most important, even though I'd probably put it on the same, I would probably put it on the same stage here in this context as one, preparation, but the probably not even as close as important part is the execution part, which everyone is focusing on when watching such a webinar, which makes complete sense. I mean, this is what the impression you probably get, but professional trading and success in trading is based especially on the preparation, everything you put into planning a trade, and then on the review and the tweak process at the end. And then what you do next time you get some information out of this, you repeat this process again. You plan the trade, you trade the plan, you review and tweak, you repeat. And this process over and over again will bring you to something we will then get to know in the second presentation, the trading psychology part. We will look at this and find out that this is something which, based on repeating it over and over again, will result in something we call unconscious competence. So just do it, like driving a car, for example. You don't need to think about how to drive a car. It's just there after all the years of experience you gained by doing it over and over again. And this is the same when it comes to trading. So this is a classic learning example on how you learn how to improve that in this context. And so why is risk and money management and trading psychology now so important? It's important because it makes it possible for you here to review and tweak your trading. So to give you a motivation why this is important and why you shouldn't leave the webinar here and saying, well, I don't care about this, is because this is probably the crucial part to become an overall successful trader. Even though at first it doesn't look that exciting, I try to make it exciting. So now let's start. Risk reward ratio, expected value, payoff ratio, these are the key components, especially when it comes to understanding the importance of in the theory behind risk and money management, and why this is important. We will see and we will learn in a few minutes. Scaling into and out of trades, this is a technique which helps you, in fact, to increase the payoff ratio and the overall expectancy in your trading. So this is, in fact, something you can use for your trading, even though I will give you only a quick and rough overview of that. Position sizing, that was something we already mentioned during our open webinar. So the introduction webinar we did several weeks ago, we focused on Kelly and the Kelly criterion, so we don't dive too deep into this. And at the end, I will give you a very effective way how to manage your position size in your trading when you start trading, and which position size you shouldn't exceed, especially. So you shouldn't over leverage your account, and this is where the effective leverage technique comes into play. And beside of that, and I think after payoff ratio, we will go through what can we expect as a professional trader. Does it make sense? This is also a question we want to answer in this context. And what I want to do, and this is what I found out then after I read the question from John in the morning, here in Germany, was it probably makes sense to give you such a simulator we will use here in this context to give you a better starting point to what I mean by that. You will see that once we are there, to give you a good mental stability. And then what I want to do is I want to show you some real trading stats from my end and simulations based on that, what I can now, if I can stabilize these numbers respectively, if I can continue to grow and to improve in my trading, what is possible then to probably reach. And so theoretical combined with practical and real numbers of the real world. By the way, I just see here that the chat box is seeing lots of action. I already introduced myself yesterday, so we don't want to waste any time on that. Admirals, I think, should be self-explaining, one of the financial leaders in the service, financial service community for 20 years now. Sees a rebranding right now, so it's Admiral Markets, which is becoming Admirals now. Why is that? Well, because they extend their overall product offering from financial service products like CFDs, FX, for example. They also now go to the part where they offer a credit card, if I'm not mistaken, at least for the CISEC regulated part. Probably they will extend this also to other regulatory bodies. But so financial service provider, which we refer over here in Germany as the so-called DAX expert. So with the most competitive offering when it comes to DAX trading, but you will also find a very competitive offering with very tight spreads, very low commissions when it comes to precious metals trading, when it comes to stock trading, stock CFDs, when it comes to physical stocks, when it comes to what did I miss? FX, especially Forex, very tight spreads. And so we could also do a presentation on that alone, why spreads, for example, and the commissions and the price you pay, the cost of doing business is such an important part, and why a broker of Admiral, like Admiral Markets here, is a broker you should definitely take into account when opening an account with the broker due to the low commission structure. But that's just beside of that. Any further information you find on the website, admiralmarkets.com.au, I think, for the Australian part. And what we want to do now is look at the risk reward ratio. But before I start, let me just check the chat box here. 1 second. So good evening, good evening, good evening. Yes, questions? Okay, perfect. Oh, no, I see. Okay, there was a question on the recording from yesterday. Yes. So we start with risk rewards and why this is of importance, respectively. We, in fact, take over the thoughts from yesterday. I'm not really sure. I just realized in the morning during brushing my teeth, I was just like, did I mention that it's not possible to say whether the market goes up or down, which is very irritating probably for some of you, because you would say, well, I listened to you yesterday for over 2 hours. You were talking about technical analysis. You were talking about identifying chances. You were giving some ideas on what to expect for the crypto world. We draw a picture, which we will also use here in this context now for the ASX 200, probably break down if a certain level is broken. And now you're saying, after all this technical and all this fundamental research, it's not possible to say whether the market goes up or down, but you're a trader. Isn't the job of a trader to say whether it goes up or down? No, it's not. In fact, it's not. So as a professional trader, you make intelligent bets. This is what you do, and it's all based on risk reward, in fact, and this is all what it comes down to. But it's not possible to really say whether the market goes up or down. And this is the moment where we build a bridge now from market analysis, so research, especially from a technical perspective, over to the risk reward ratio. So what market research does, it helps us to identify an advantage in our trading. So given the overall picture, we can now say, well, it's more likely that this happens than that this happens. And based on that, if something is more likely, it doesn't mean that it's 100% correct. So like, I mean, right now, for example, that's a perfect example out of the real life. For example, everyone is saying vaccines, when it comes to the corona pandemic, are safe. And why do they say that? Well, because they have some numbers, some statistics, which say in 95% of the cases, nothing happens. And they are safe, or they overcome the virus, or whatever they might say. But it's very interesting if you read in case of Germany, but also I think the same will be true in Australia. You can read this in the UK. You can read this in the US. It's safe. If something is safe, it means there is no risk involved, at least in my world. So as a trader, I look at this and say, hey, this is a 100% sure bet. We all agree, and we all know that there will be certainly some side effects. If these side effects are good or bad, or that doesn't really matter. But if someone tells me it's safe, I assume that's 100% sure. That's the same is true when I say, where there's a tendency for human beings, and this is something we will also focus on in the psychological aspect. Once people say something is more likely to happen and has a probability of, let's say, 70, 80%, it's a natural tendency, a human tendency, to round it up to 100% and say, hey, if it's 80%, well, obviously, this should work out. Some of you probably played online poker already somewhere, or in a casino, for example. I know that in Melbourne, there's a very, very nice casino. And I think it's a Crown's Casino, if I'm not mistaken. So I just have the picture right in my head. So there's also, if you play poker and you, for example, if you're playing No Limit Hold'em, for example, you have 2 aces in your hand. From a mathematical standpoint, you have an 80% chance of winning. But 80% is 8 out of 10 times. 2 times on average, you will lose the hand. How many times have you gone on monkey tilt because you lost with 2 aces against whatever card combination, king, queen, or whatever? And this happened to me. That's why I tell you this story. And there's a natural tendency now to say that something is safe or something has 100% accuracy. This is something you will or you should take a step back from when it comes to trading. So there is no such thing as 100% accuracy. But what we as traders do is we find spots where there's an advantage in our direction. So we have an advantage on our side. And what we now try to do is, based on intelligent bets and a positive skewed risk reward, if you want, to somehow gain an overall rising equity curve. That's what we do. And we try to capitalize on our overall positive expectancy. The next slide will show you that. And but let's come back to the risk reward ratio now. So what we do based on market research is in fact spot areas or spot a region where we have a favorable risk reward ratio, which we then want to capitalize on. So this is what it all comes down to. And so in case of market research, it answers the question when an advantage is not given anymore. That's very interesting. So I talked about if the advantage is given. But in fact, what's more interesting is that you ask, and this is where the stop you place in the chart comes into play. So if you place a stop, this is like a question you ask to the market. And you ask the market, are you still, let's assume you went long, are you still long here? If the stop is hit, then the answer is no, I'm not long anymore. So this is how you can see how your stop communicates with the market, respectively. Think about placing a stop in the market as a question you have towards the market here and ask him, hey, am I still right? Is my thesis here still correct? If the answer is no, well, then you shouldn't have any problem to get stopped out. I'm not saying that it's nice to get stopped out and lose money, but it's just part of the game and probably a better way to tackle this problem, which you probably face several times, will naturally face, to place a stop, because you say, well, probably someone just wants to take out my stop or something like that. This is naturally something. You place your stop and you ask a question and you get a direct answer. So there's no talking around this. It's just the answer. No, I'm wrong here, or I'm not long anymore. And thus your long thesis is not given anymore. And this is what you do by placing a stop. And it also means that the overall picture probably changes. And it also answers, in case of market research, it also answers the question how big your potential reward is. And how big your potential risk then is. What does this mean? Well, let me just give you an example out of the real world. Let's come back here to the ASX example from yesterday. So what we said was that we could here see a consolidation. And if now things start to somehow get ugly, volatility picks up, if US yields continue to rise, if there's some tensions building, for example, between the US and China again, whatever reason there might be, probably we will see a potential top out here. And if we break here below this area, this blue line, the upper blue line, this is 6,550. We already said probably there's a first clearer sign once we break below 6,650 points. If this happens, we want to go short. And if we get to see a break, especially below 6,550, we bet that we'll get at least, or we assume that we get at least a retest here of this former strong resistance, which then now turns support, turns resistance once it's broken, or resistance turns support, that way around, once it's broken here on the upside, that we have then a potential target on the downside around 6,150. So that means if you enter here at 6,550, once we break below that level, and you aim here for the region around 6,150, you obviously aim for 500 points. So this is the target on the downside. And then this is a potential reward, but still you ask the question, okay, and when is my thesis wrong? So just assume you get a fill here once we break lower, but if we just get a spike lower and then the market turns around and pushes higher, when is our point once the market tells us we are definitely wrong on the trade? And this happens once we make new highs here. So if we get the spike into a position here, as shown in this chart, and we are not seeing this sequence, then with a push lower, but instead we see a spike into the position, a potential, let's call it a fake out, and then we move higher and we go straight to new highs here, and the market makes new yearly highs in this context. Well, this is the clear answer that our assumption that the market now broke lower and will continue to trade lower over the next days is definitely wrong. We go up to this level. So what we do here is we now calculate on a risk based on that, because once the market breaks to these levels and above them, we are wrong on the trade. So we entered at 650. Our target is around 6150, 500 points. And what's our potential risk? Well, if we enter at 650 and we have our risk here at 6850, this is 200 points. So the risk reward is 200 points risk. And this compared or in relation to 500 points of chance, we have a risk reward of 1 to 2.5, which is quite favorable. So we get 2.5 times as much if we play this over and over again, and if this plays out as expected, as here, 2.5 times as what we risk. So let's assume we risk, let's say $100. So on average, based on our research, we'll make 250, 2.5 times as much. Now the thing is, and there's where the first question will naturally arise, but this assumes something which you just said at the beginning is not possible, to say whether the market goes up or down. Because what we do here is obviously we have a research and we have a solid thesis, everything's fine, but still we don't know whether this will play out that way. So there will be times when we see a break lower, but the market will never reach our take profit level, or we get stopped into the trade and then the market just trades sideways and sees no dynamic direct feedback. We do not get a direct feedback. So you might say, hey, this is like that doesn't make sense. If you say you can't say whether the market goes up or down, and now you assume that this risk reward is obviously it's purely theoretical. No, it's like it's not real. This is 100% correct and 100% right. But the thing is, oh, I made a mistake now. Okay, so I have to I jumped now. Now you might wonder, how can I calculate my reward, my potential reward, respectively the risk. What I want to say is this theoretical aspect is 100% right, and something which directly brings us to the point where these components, market analysis and risk reward, start to play with each other. So looking at the risk reward avoids that we not make mistakes, but that we take not intelligent bets in our trading, which means think about the situation when you just saw whatever asset you were looking at. May it be the ASX 200, may it be Euro Australian dollar, may it be Australian dollar against the USD, may it be the gold price, whatever, gold mining stocks. And the market broke above a potential strong resistance and then took on momentum and just moved and moved and moved higher. And you were sitting in front of the screen and just wondering, should take the trade now? So, and now there's a psychological thing happening, a cognitive bias we usually refer to as FOMO. It's the fear of missing out. You fear that you're missing out the move, which you already saw in advance, but you said, I wanna take the trade here for whatever reason. You forgot to enter the order, whatever. The market shot above that level, continued to trade higher. I mean, you can certainly say that's a mistake to not place the order, for example, but this is a different question. That's another question, and we have to answer later. And what we can do to avoid this in the future. But right now, you're sitting in front of the screen and you see the market moving higher and you're not positioned. So the question you now have is, shall I enter the trade? And here, the risk reward ratio delivers the answer. And most of the time, it's a no. It's no, you shouldn't enter the order here, or you shouldn't enter the market here, because the market moved already too far in direction of your anticipated move here, because now the risk grows extremely great, while the potential reward is diminishing. So bringing this into this picture, for example, we could, for example, say, hey, is it really enough that the market breaks? Let's say, in this context, we're not forgetting to enter the order, but we want more confirmation. So usually you pay more confirmation. The price you pay is an unfavorable or more unfavorable risk reward ratio. So which means if you say a 6,650, is it really enough to get to see a break here? I'd like to see a break below 6,550. So this is really a crucial region, one which already played a high significance in the past. Well, so I enter the trade here. I still have the same target, and I also have the same potential stop level. I say 6,850. This is the place where I'm wrong on the trade. But now you're entering 100 points lower. So that means your risk increases by 300 points, while here your reward, your potential, with a target around 6,150, it decreases from 500 to 400 points. So now the risk reward is not 1 to 2.5 anymore. So in our case, 200 points risk and then 500 points potential reward. But now it's 300 point risks and 400 point chance on the downside, or reward on this case, which means that the risk reward ratio drops to 1 to 1.3. This is significantly unfavorable. It has a massive impact on your overall profitability in the long run. Why? Because it's unlikely that your hit rate will increase. Even if you get more confirmation here, probably it will slightly increase, but the increase of your hit rate overall won't really result in your overall profitability to reach a new high here, or to stabilize at a level of 1 to 2.5, and as this risk reward is paying you. So that being said, let's come back to the presentation. So that being said, it's very important to understand that risk reward ratio is a crucial component which tells you the overall expectancy in your trading, and which will avoid, or help you to avoid, to take unattractive bets in your trading. So the risk reward is crucial. Even though it's purely theoretical, we will see the real world risk reward ratio. This is something we refer to as payoff ratio, and it has a massive impact on your overall profitability. But it's based on real numbers, while the risk reward is based on your research and based on your expectation, based on your expectancy of the market doing this or the other way. And once you spot a positive risk reward trade, it doesn't mean that the trade will be profitable, that you will make money with the trade, but at least you see that if you have a higher reward than risk you take within the trade, that this is then a potential intelligent bet, especially if you can argue why this should happen the way you just analyzed it. So when now looking at potential reward, it makes sense to look at the following components. This is getting now into a very practical approach, and we could also have a 1-hour event on this alone to spot what is realistic when it comes to chances, potential rewards, especially because you might say, okay, I can to some extent easily spot when I'm wrong on a trade, because I say, for example, the market, I'm going short. If the market makes new highs, well, I have to exit the trade. But how far can a potential market move? So if you say, for example, we are now at, let's say, 600 and 800 points, 6,800 points in the ASX, and you say, well, I expect the market to drop 2,000 points. That's probably something which could happen if we get to see several similar developments as we've seen 1 year ago around the COVID-19 pandemic hitting, and all what is connected with that, and the massive deleveraging which took place around the globe. But it's not the most likely scenario. So most of the time, the market won't drop. Let's put it that way. It won't drop 2,000 points. And to avoid such a massive expectation which is likely not fulfilled, and which most of the time only is due to the fact that you say, I want to have a positive risk-reward ratio. What you should do in this context is then look at components which are, let's say, market-based. What happened in the recent past. And there, for example, there's an indicator, which is also included in the MetaTrader, by the way. So it's the average true range. I have here the RSI. Let me take out the RSI and let me include the average true range. I really like to use the average true range in this context. You find it here under oscillators, under indicators, oscillators, and it's right at the top. So it's average true range. And what it tells you for the last, let's say, 14 bars in this context, it tells you the average daily trading range of the last 14 daily candles in this case, since we are looking at a daily chart. And as you can see here, for example, for the last 14 days, the ASX traded around 100 points. So, which means, like, you can already see here that if you enter such a trade with an expectation of the market testing this region around 6,150, so you have an expectation of, let's say, 500 points, it won't, unlikely, it can, but it's unlikely to happen in one day, but it will take several days. That's also something from a mental perspective, which is very important to have already an idea. So some of us want to see a direct feedback, which is completely fine, but it should be a realistic feedback, and a realistic feedback from the market in this context, what we can expect to happen within one day. And the ATR, for example, gives you a very, very good first step to see that, even though it's based on historic data in this context, but it's still a very nice way here to get an idea of what you can expect in terms of volatility for the upcoming days. And so this is my first tool, ATR. We have certainly a potential resistance and support regions, which we just did here by drawing, for example, a target on the downside based on a former resistance zone, which now turns a potential support. We have also sentiment extremes. This is something which is currently a little skewed, let's say. For example, if you look in the US, you will see that there's lots of chatter around retail traders entering the market. Usually we have a tendency based on a psychological phenomenon, which we will make a topic in the next hour, then in the psychological part of this presentation, where retail traders tend to underlie this concept of loss aversion. So overweighing losses compared to their winners. And that means that based on that, they tend to take out stops, respectively work without stops, because taking a loss is so painful, such a painful experience for the classic retail trader, that they tend to keep losing trades open longer than they keep winning trades open, which naturally results in then cutting the winning trade short, letting their losing trades run. So this is the basic idea behind that. And this can result in potential sentiment extremes. Sometimes this behavior grows so intense that markets seem or start to bounce back to mean revert, we can also call this. And this is also something we should keep in mind. So if a market grows overly confident that it moves higher and higher and higher, it's likely that it will see rather sooner or later at least a sharper pullback. If this is happening, well, this directly affects your overall tendency to take long trades, because now the risk reward is not in your favor anymore, or at least you should be really careful to expect probably too much on the upside. Respectively, the same is true for the downside. And this is what I mean with sentiment extremes. And I have now here something which is probably, I mean, I know talked a lot and we had a practical example with the ASX, but I probably, some of you might say, okay, yeah, risk reward is obviously important, nice, but okay, can we just move on probably? I fully understand that, but still, I want to finish this risk reward with this picture here, which shows you the relation of profitable to unprofitable traders, and what happened here. So this is data from a broker, quite big broker, used to be a quite big broker, and it's information I received in my position from a client who just forwarded me this. And what we can see here is the relation of traders who worked with a risk-reward ratio of less than 1 to those who worked with a risk-reward ratio of greater than 1. So the data is, by the way, for 1 year. We are looking at millions of trades. So so really millions of trades. So Euro USD alone in this context here had nearly 10 million trades. The period is between 2014 and 2015, so it's a 12-month period. And what happened here, what the broker did was the broker did the following. He took those trades who were opened and probably, let's say, showed a win of 10%, 10 pips, for example, in Euro USD, and then compared it to the overall risk these guys were taking, respectively, the loss which happened. And what he found out was that the traders who tended to have significant smaller winning trades compared to their losing trades, given the fact that the risk-reward ratio they were looking for was unfavorable for them. So they looked for a risk-reward ratio which was less than 1, that this resulted in a massive unprofitability of retail traders. So which means traders which are who are trading with a risk-reward ratio of less than 1 are likely unprofitable in this case here in more than 80% of the cases. This dramatically shifted once we had a risk-reward ratio of greater 1. So people who were really looking to capture more in case of winning than risking initially. So once the risk-reward ratio switched to greater 1, the profitability of these traders trading that way went to above 50% in this case. So this alone, I think, is impressive enough to see why a positive risk-reward ratio and understanding this concept in depth and going for trades which have a greater reward than your risk which you're taking, why this is definitely something you should keep an eye on and keep in mind when taking your trades, and why this is where all your overall profitability probably in your trading starts. So what does this mean? I have a final reading here, because this is something you might now say, hey, does that mean if I always look for potential positive risk rewards here in my trading, that I'm then profitable? It's a clear no. So don't get me wrong. If you read a book or if you listen to someone in a webinar, someone teaching you something on trading and saying, hey, watch out and look for risk reward ratios, which let's say are 1 to 2 or 1 to 3 or something like that, then you're on the safe side and you will certainly make money in trading. That's not what this graphic tells you or what risk reward is about. Risk reward ratio, this comes down to it helps us to avoid making unintelligent bets. So an intelligent bet is a bet where you can make more than you're initially risking. And this is exactly where risk reward comes into play, and why this is important can be seen within this chart. So now let's go through the expected value. And here in this let me just go back. If you take a screenshot, you want to take a screenshot from this presentation, take a screenshot from this slide right now, because this is the most, no question about that, the most important formula you will ever see during your trading career. It's the most important question you will receive is, how can I measure profitability in my trading? And profitability in trading, I mean, how many times have you probably seen someone telling you, I'm a profitable trader? What does profitability in trading mean? I mean, someone will say, hey, I just made money today, I'm a profitable trader. Someone will tell you, hey, I made money the last 7 days, I'm a profitable trader. Both are not profitable traders, at least not per my definition or by my definition in this context. But someone who makes a trade, a good trade, based on the parameters which are going into such a good trade, having a potential positive risk reward, for example, taking the overall market context into your preparation, into your consideration. Good preparation, for example, is also something which makes one good trade. But still, you can be as good prepared as you want. You can have a thesis which is great. You can have a setup which is positive for your personality, respectively, which has a positive expectancy. You can then probably see it on the chart, that the setup's happening. You take the trade, you fight for a good price here. You have all components in your direction to make one good trade in this context, and still the trade can be a loser. Just that's natural, it happens. And still it's a good trade. It has a positive expectancy, because if you repeat this, let's say 1,000 times, you will come out ahead. Certainly, I assure that, because it's based on my personal experience at least. And the thing here is that this is where profitability comes into play. And it also illustrates, by the way, why there's this old saying where people say, let winning trades run, cut losing trades short. You can see here the hit rate and the loss rate is something you can't directly influence in your trading. You can say whether the market goes up or down, but what you can say is, did I place a stop? And is the stop answering my question, am I wrong here? And if this is the case, you're cutting your losing trade short. So you cut your average losing trade, while you also find ways to manage your trades in a way that you let winning trades run. You make your average winning trade great. So if someone tells you, let winning trades run, cut losing trades short, he's, especially a professional trader, is not saying that because it sounds smart, but he says that because he knows that this directly influences the expected value and thus the overall expectancy in your trading. If this number is greater 0, you will make money. I have now some examples here to show you that it's possible to make money even if your hit rate is below 50%, and even if you have a hit rate of 90%, you can still lose money. So for example, here, if we have a hit rate of 50%, so purely theoretical example, a practical one will follow in a few minutes. If you have a hit rate of 50% and the loss rate of 50%, and the average winner is 60 and the average loser is 30 points, it's a highly profitable approach, because now you can calculate the expected value. You can put in these variables here. The hit rate is 50%. You multiply this with 60 points, and you subtract the other 50%, the loss rate here, with 30 points. And then you have 30 minus 15 points. You make on average per trade 15 points. There's no point value attached to that. So you can say a point is $10. Well, then it's 150 euros, or Australian dollar in this case, you make per trade. It could also be $1. Doesn't matter. At least it's greater 0, and that means it's all in all a good bet. Respectively, it's an overall profitable approach you're following here. The same is true if you have a hit rate of 40%, loss rate of 60, and still have an average winning trade here of 60 points and an average losing trade of 30 points. If you put in these variables in your formula, you still come out ahead. On average, you make 6 points per trade. It's greater 0, so it's a good trade. I'm sorry, so there's something missing. So now let's have a look here at the hit rate in this context of 90%. You might say, hey, you're a professional trader. Professional traders are right all the time. I assure you, no, they are not. And I can show you that here in this context, for example, 90% hit rate does not equal being profitable in your trading. Because if you have a hit rate of 90% and a losing rate of 10%, so you're right, 9 out of 10 trades, but your average winner is 10 points, while your average losing trade is 100 points. You let your winning trades, you cut them short, or you let your losing trades run. Well, this results in -1 point on average. -1 point means you're losing 1 point on average per each trade you take. So this is definitely a bad bet. It's not intelligent to trade that way. And this is where you can now see where expected value comes into play, and why this is such an important component of your trading, why this formula is so important. If you take trades based on expected value, and now there's also something which I already mentioned at the beginning, having a trading journal, document your trading well. You can find out whether your decision made sense or not. What do I mean by that? Well, there will be times you're sitting in front of your screen, you have a trade moving in your direction, and then you take profits because you said, well, this is the point where I want to take profits. Let's go back to our example. Let's assume this trade plays out. We break lower, and then we move into this direction and have our take profit here. And then something like this happens, as did last year, here with Corona and the COVID pandemic hitting. So you're now trading here. You see the market stabilizing at this level, around this. Probably you're now saying, hey, probably we're finding a long trigger. So former resistance now becoming support. Why shouldn't I give it a try and trade long against this level after I made some money on the short side? And then the market sells off sharply and we move dramatically lower, probably because the next mutation is hitting whatever. So let this be a simple example. So now you might say, hey, did it make so much sense? I mean, we didn't take the long trade. Okay, let's assume this. But we took profits here and now see the market really selling off sharply. And you're probably really frustrated now. You're sitting in front of the screen saying, hey, I just took a winning trade massively short because I was on the short side. I did make money, great. But now I'm seeing the market selling off sharply from here. Is it really, was it necessary to take out the trade here? That depends. I mean, first of all, I'd say, no, you didn't make a mistake at all, and you shouldn't be frustrated, but you should look now for opportunities to capture some meat of this obvious short market environment in which we then find ourselves. But what's also interesting here is it's not just that it was rules-based, but you should also take into account that probably there were reasons which told you to take profits here, because the market, for example, looked very extended when it moved in this direction. Certainly, there will be times when such a flash crash happens and the market continues to move aggressively in your favor, and you are not positioned anymore because you already took profits. And this is exactly where the formula comes into play. Now, we don't dig too deep into this topic, but what you will do in this environment is you will answer or ask the question, does it make sense to take profits here then? And what you do is you say, well, or put it differently. Let's assume the following. It's probably a better example. You say, I want to see the market move 100 points in my direction. And then the market moves, let's say 90% in your direction, or 90 points, 90 points in your direction. So, and now you see that so far you haven't trailed your stop. You're still in the risk of the trade, the risk of losing money. But it's a make or break trade. And you say, well, I want to see the market move these further 10%. But let's assume that your initial risk, let's say, is 50 points. So 100 points reward, 50 points risk in this case. So now you're risking that the market will move 140 points against you, and you're only aiming to make 10 more points on the upside. So given that, looking back at our risk reward, so our risk reward, which was initially making 100 points and risking 50 points, now switches to making 10 points and coming down to a 140 point risk. So to get now a positive expected value, to make a profitable trade decision in this context, what does it mean, or what does it need? Well, I haven't the numbers right now, right here, but you have to now have a massively high hit rate that these 10 points will be made over time, not just necessarily in this one trade, but in all the trades you do that way, so that this overall expected value is still positive. Once this turns negative here, because your hit rate is not high enough, because the market is not moving these further 10 points in your direction, you should start to think about trailing your stop, respectively taking profits. So this is then the next step you have to take after understanding this formula around the expected value. This is crucial to understand. And it affects directly your overall profitability in your trading, and something to keep in mind, and why I emphasize that this is probably the most important formula you will ever see in your career, in your trading career. So now we want to look at the real risk reward, the real world trading risk reward, the payoff ratio. I'm not really sure whether this is known in the English speaking world, to be honest. So I remember a call I had with a trader from the US who looked at me as if he has never ever heard about this before. So payoff ratio, and that's why I wrote directly here below that the definition below that. Payoff ratio is what we define as average winning trade in relation to our average losing trade. And you can see that the expected value, and this is where letting winning trades run and cutting losing trades short comes into play. If this is a great number, while this is a small number, your overall chances of being profitable, having a positive expectancy in your trading and being profitable in your trading is extremely high. And the payoff ratio obviously shows why you should let winning trades run and cut losing trades short. And the payoff ratio obviously directly affects your overall profitability in your trading. And in this context, this is a chart I want to share with you here, which we don't want to dig too deep into, but there's obviously a direct correlation of your risk of ruin, of your trading, not trading losing money, but you're really losing your account, or at least lose the amount of money you set yourself, and where you said, well, this is the amount I'm willing to lose during my trading. So this is your point of ruin, or the risk of ruin in general. And the payoff ratio, they're directly attached to each other, because we have here a greater chance of being profitable the better we are at letting winning trades run, cutting losing trades short. While if we take winners quick and let losing trades run, well, then we have a massive problem here when it comes to our overall, not just profitability, but probably we are risking to really ruin us and bust our accounts. So still, probably you will see this now and say, okay, I understand this. That makes perfect sense. Everyone repeats this over and over again, letting winning trades run, cutting losing trade. Great. But I mean, let's assume I have a payoff ratio, let's say, of 10 to 1. So I have an average gain in my trading of, let's say, 10 times the amount I'm risking. Let's say you risk 100 USD or Australian dollar, and you're making 10 times that once you're winning. So you're making 1,000 Australian dollars in the winning position. This is great. The only problem is, let's assume that you have a hit rate of only 5%. You will see that this is directly affecting your overall profitability. You will not make money in this approach. So you have a hit rate of 5%, 1,000 Australian dollar average gain. So this is 50 here. And then we subtract 95 of 100. It's 95 in this context. I'm sorry, 95? Yeah, 95% multiplied with 100. So it's 95. So there's a minus 45. So it's less than 0. So you have a phenomenal payoff ratio, but still you will lose overall because your hit rate is not high enough. This is something which is definitely you'd have to take into consideration, and why market research then, and this is where we close this cycle, if you want, and why the market research aspect is so important, and to learn over time, learn about the markets, learn about the behavior of markets, which will naturally result in your hit rate increase too. So while it's definitely still not possible here in this context to say whether the market will go up or down, you still have, and this is natural, with more experience, you will gain the confidence by taking trades, because patterns repeat, or at least the past does not necessarily repeat, but it rhymes to some extent, let's say. And this being said, increases your chance of being on the right side of a trade. So some might call this intuition to some extent. Sometimes you just look at a chart and say, I've seen this before. And this being said, I am willing to take risk here on this trade. And you will see that it plays out again, given by what happens there. This is something you have to do research about then. It's not about I see this and that's why I do that, but you have to make it repeatable. You have to find ways to find out why this happened and why it makes sense to trade this over and over again. And these are then the trades which which you can write down, which you should sum up, let's say, in your setup a book, let's say, where all your strategies are written down, and take these strategies and do more of them, because you repeat them over and over again, which naturally will result in you increasing your hit rate and thus your expected value. And by also letting winning trades run, cutting losing trades short, you can see how the overall picture of profitability in your trading comes to life. So now the next thing is here we could now talk about scaling out of trades. But what I want to do instead now is I want to answer the question from the a guy who asked how much money you can make trading. By the way, let me just see that I have the question here. We are on the same page. Let me just see. Where is it? So it's the question about benchmark profitability and what is a realistic, typical profitability range for a professional trader. Someone who religiously follows strategy, risk management, and good psychology practices. So it's a fantastic question. It's a great question, and some we could easily talk another hour about. What I want to do now is I want to answer the question first, and then already give you a starting point on what you can make out of all these information right now, especially when it comes to payoff ratio and the hit rate, especially. So let's come back here to this formula here, expected value, so that we have this. So it's very difficult to answer that question. It's obviously very difficult because it depends massively on the level of experience, for example. Or let's give a direct example. So there was, or there's a very successful stock trader over here in Germany. I know him personally. He's also located in Berlin, but he's someone who likes to stay in the background. So he's not really willing to tell the world that he's a successful trader. But there was a time that was in 2017, 2018. We all knew in the industry, we already knew that he was very, very successful, but he's shown that to the audience, respectively to the public back then. So what happened? There was a competition for himself. He went to a guy who has some kind of media company or something like that, and he told him, well, I want to do an experiment. I don't know whether it will work out or not, but let's see. So this guy from the media company, he's also in trading and not as successful. I'm not sure if he's successful at all, but he's fascinated by this world of trading. And then you probably have seen about the stories of all these gurus out there and telling the world how much money they make. Most of the time they don't. But in this case, now this guy wanted to show that he really can make money. And what he wanted to show, it wasn't really that he wanted to show that he can trade. We all know that, he knows it himself, but it was more like, is it realistic? That was his question at the beginning. Is it realistic to live out of an initial deposit of 10,000 euro at this point here? Can I make so much money trading a 10,000 euro account over 1 year to live comfortably? So that was his question. And so he took the account, and to make a long thing short, he made 100,000 out of 10,000 with very strict risk money management parameters over 1 year. 12 months, he had a 10-bagger. So now this guy is a very competitive person. And I said, well, I can live out of 100,000 a year, but probably I just got lucky. So that was what he said. Everyone was shaking their heads in disbelief and just saying, well, that it doesn't seem as it was luck, but okay. If you think it was luck, what do you plan to do about this? Let's do this again, he said. Next year, 10,000, 10-bagger again. 10,000 traded up to 100,000. So this is not a coincidence anymore. And this is, I think, already showing what's possible if you have a certain level of experience and skill. So it's doable. Could I do this? I hope so. I never had a 10-bagger during my career so far. I'm very competitive, and I hope that one day I will reach this level of excellence in trading to have a 10-bagger. But still, it's more important to wonder or to ask, does it make sense to look at such results only and solely, especially if you start out trading the markets? I don't think that this is very good, or that I think you should avoid this result. If it happens, it's because of you going through this process, which I showed at the beginning again, over and over and over again, and religiously. You followed this routine here. Plan the trade, preparation, lots of preparation, all what comes into this. You trade the plan, you review and tweak, you review, you have an overview of what went good, what didn't went so well, and then you do it again. You formulate a solution for the problem you just spotted, and then you try to make it back the next time. So you try to be better every day, and again and again and again and again. And there will be naturally, rather sooner or later, there will be excellence which follows. It's no other way than that, because if you continuously try to improve, there's no other way than to be successful rather sooner than later. The question then is it realistic to make so much money out of trading that you can comfortably live out of your trading gains or your money you're making there. That depends massively, in my opinion, on what your level of comfort, no, not comfort, but what you need to have to have a not meaningful life, but a life which is comfortable in this case. So you can feed your family, you can live comfortably out of this, you can go on vacation once a year. I don't know. That depends massively on your own and on your individual needs. I once said that given my overall costs, living costs here, that I probably need a higher six-figure amount to make enough so that I could comfortably live out of my trading gains. And even that is something where I say, well, I'm not really sure if trading is what I want to do alone. So I'm fascinated. I love trading. I really love what I'm doing. But I have to say, I have to admit that if it was only trading and not doing such webinars, talking to clients, exchanging ideas, doing webinars, for example, doing something on educational purpose and all this, I'm not really sure if I'd enjoy it as I do it right now. So this is something you should keep in mind. Then to give a clear number, what's a great number to achieve, to have a clear idea, especially if you're, let's say, a money manager, probably asset manager. Let's say you're playing Champions League. So you probably heard about Champions League here in Europe. This is the league where the best of European soccer teams meet, in fact, and play out who's the European champion. So if you make 25% a year net, I think this is really top notch. Something you will find not many times anymore out there. There are not brokers, but asset managers who achieve these numbers, but sometimes with massive risk. They take to some extent. This is probably also given by the overall market conditions we currently face. But I'd say 25 to 30% is doable if I'm trading for myself as a retail client or retail trader in this case, but still professional. So I consider myself a professional trader, but professional retail trader. I could easily make more money than that because of my flexibility, because of the higher leverage, because of me having chances when I see, for example, a spot where it's fine to move all in. What does all in mean? All in this context doesn't mean you're risking everything you have, but it means you have a daily risk, say, of 1,000 USD, and then you say, well, 1,000 USD, I'm risking all this daily stop level here on this one trade, and increase the position size because I think I just see it, and then this is the moment once I move all in, and I want to capture this move I'm just seeing here. What I like to do in this context, let's go back here to this slide with these examples. Again, you should be really careful about such result-oriented targets you set yourself. I definitely have not made many very good experience with that, even though I most of the time succeeded. For example, during my studies, I traded for a living / I also played online poker for a living, for example. So I lived a life on optimizing my positive expectancy in my trading. So there was high risk involved. So it wasn't that I had a classic office job. So I worked as a professional trader, yes, but I then went out of myself quite soon after that. So and so there was always risk involved, and it's something where I succeeded, and I know the pressure which goes hand in hand with that, because at the beginning of each month, you set yourself a target for this month. You said, I have to make this amount of money to feed myself or to pay the rent, for example. And this puts so much pressure on you. You learn so much about you and what you need and what you're looking for and what you don't need and what you don't want to see. And also from a social perspective, there are so many components coming into play. I mean, there were friends meeting and going to the club in the evening. Well, I said, I'm sorry, but I have to play a tournament here. Respectively, I have to relax from my trading session. I'm completely tired and I'm completely burned out, and I really had to calm down. And so this is something you have to take into account when it comes to results. And this is something, again, I don't want. This is just something you have to ask yourself. And this is also something where then now the following comes into play, and what John mentioned at the beginning, when it comes to the trading psychological profile. There are many questions you have to answer for yourself. And these questions, I wrote a questionnaire several years ago already on where to start such a trading psychological profile. So it's not just that you have a one sentence there, but you really should think about who am I and what do I need and why I am where I am, what does support my career to be a trader, for example. So there's this very, very deep questions, and you should take time to answer these questions for yourself. Once you know that, and also especially when it comes to your trading strategy and your clear numbers around your expectancy, your hit rate, your payoff ratio, you then have to formulate an idea on what can, or no, you want to know what you can expect, and based on what you can build your business on. And therefore I created something. I wrote a book. It's a German book, so it's not of use for you here since it's in 100% German. But when I wrote this book, I wondered, what can I do to make this, not so interesting topic, especially around risk and money management. Coming back to this, what can I make? What can I do to make this really an experience for the reader, so that once he reads this, he finds a place where he can use his knowledge now and play around a little, and also use this in terms of what can he expect for his trading, and thus combine risk, money management, and mental stability here. And therefore, what I did, and what I want to show you here is, is here. This is a website. So I created a website. It's a .de website. It's trader-dasbuch.de, and there's a Monte Carlo simulator. And this Monte Carlo simulator now gives you a chance, but it's in German. So I walk with you through this process here. I think it's self-explaining, but what's more important is to see how these numbers potentially affect the overall not just profitability, but also the equity curve you can expect. So let's assume you have a 10,000 euro account in this context. You can easily exchange this number: euro, Australian dollar, USD, whatever you want. And now you say, I'm looking at 500 trades, and then I have a hit rate here of 50%, and I'll create 15 different equity curves. And I have a payoff ratio, so average winning trade to average losing trade, of 2 to 1. Let's have a look here at the presentation again. So these are the numbers from the first, okay, where we said that we have an average gain of 15 points per trade. And now what we do, now what we do is we say we risk 1% per trade. And now this is a Monte Carlo simulation, which is Bernoulli distributed, we call this. Bernoulli distribution means, very simply speaking, that we say a winning trade is a 1, and we have a losing trade, which is a 0. And then we have a sequence now of 1s and 0s, and we attach to each winning trade a win of 2 times the risk, and this ties 1% of 10,000. It's 200 euros on average we make, while we are losing 100 euros on average once we lose. And then you connect these dots and you create an equity curve. That's what you do. In fact, it's like playing dice, if you want. So you have a sequence of 1s and 0s, and then you connect the dots here. And what we have now is crazy. Okay, yeah, well, no big surprise. So what do I mean? Well, we have a high positive expectancy. We already calculated this. So here you have the Erwartungswert, is a German word for expected value. It's 50 cents per trade. So, and per euro risk in this case. So if you risk 100 euros, you make on average 50 euros here per each trade you make, if it's a winning trade or a losing trade, it's overall positive. And if you have now 500 trades and on average 250 winning trades, well, this is the result. You have a massive increase in your equity curve. So after 500 trades in this context, for example, you can expect, if you start with 10,000 USD, you could expect here that on average, the performance is 1,422, 22%. So why is this of importance? Well, it gives you already a starting point because you can only do that if you have an advantageous trading strategy. If you do not know what you're doing, if you do not have a hit rate, which you get by backtesting, for example, this is what we will focus on next week on Tuesday in the fifth part of this power course here. If you do not know what your hit rate is, if you do not know what your payoff ratio is, you can only know that if you have a strategy and you tested it in detail. You can't run such a simulation here. So this is a great thing about this. If you want to play around with this, you can easily put in some numbers. But if you want this to be as realistic as possible, you have to put in the work first and find the strategy which has a positive expectancy, and then play around with the numbers and get several distributions here in this context. And what's also important to note is here, you can see what's possible, but these numbers are based on historical input parameters, which means you only get this payout here in this context. You only get it if you can stabilize the numbers, the hit rate around 50% and the payout around 2.1%, which is showing you already where the process comes into play. So how can I achieve that? Well, focus on the process. Do more of what works, do less of what doesn't work. Probably increase your profitability overall. And this is then the point where you see where all these columns start to play with each other. You remember the open webinar we did around 1 month ago, where we said these columns of profitable trading, they all connect with each other. They are dependent from each other. It's not that they standing there independent from each other. You're an expert and you're mentally stable based on your psychological profile. But if you do not have an advantageous trading strategy, you don't know what you're doing, which means you cannot have a risk money management plan based on not knowing what you're doing and running a business. So you are losing all this here, and it doesn't make sense. So you see that you have to be an expert and study this in depth. And then your target is, in fact, and this is where the process comes into play, so to stabilize these numbers, probably even increase them, to increase your overall expectancy in your trading, to make sure that this is what you will see naturally happening to your account. So now this is 100% theoretical. What I now have decided to do is I want to show you my current performance / it's not my performance, but it's a Monte Carlo simulation based on my trading so far in 21. So you will see that this is slightly different. You see the number or the graphs here that looks very similar. I have also taken out the numbers here on the left. So it really doesn't matter of how much money we are talking here, because money is secondary. It sounds ridiculous. We're talking about trading. Everyone is here because of the money, but all in all, it comes down to the process. And the natural result, the first target is to get a rising equity curve. Money is second. It will naturally follow. It's no other way than to follow. If you continue to focus on the process to grow, your account will grow, your size, your position size will grow, and your overall profitability will grow. And once you reach a certain point in this context, where your trading grows to a level where you can, for example, feed your family, this could be the point then to decide to go out and trade for yourself, where you can already see that focusing on performance metrics alone doesn't really make sense, at least not for us as retail traders who are very, very flexible. So what you can see here is a win rate of 38.5%. A loss rate of 46.1. Now you will see, okay, there's something missing. Yes, the break-even part is missing. So I've also taken out the break-even part here. You can see where the profitability comes from. If I win, I have a massive advantage here and be able, this is one of my biggest strengths, in fact, I can let winning trades run, and I'm not frustrated if I'm getting stopped out a break even, or if I face a losing trade, because I know once the market moves in my direction, I have a strength within me and the capability to let the winning trade just run and move. And what's probably even more interesting here is that the average risk per trade is only 0.3%, which is showing that once you're doing this, at least as part of your income streams, that you naturally will come down with the risk. So I'm not risking 1% per trade, but I'm risking only 0.3 on average here. Sometimes it's a little more depending on the market conditions, sometimes a little less than that. And what we can do now is certainly we can simulate what can I expect to see if I continue to trade the way I did and stabilize the numbers around these parameters. I could imagine then, if this is playing out, that after 500 trades, which equals to something like most likely 2 years, 2.5 years, probably 3 years, depending on my trade frequency, that I tripled my account. That was the max amount. So that means if I'm starting out, let's say with 100,000, you have 300,000, 400,000 after 3 years of trading. Given these input parameters, it's also an option that there is a possibility to double the account, but it all depends on whether I can stabilize here these numbers. Becomes easier if I continue to grow and continue to make positive process and focus on the process in my trading and really focus on not just stabilizing the numbers, but also grow as a trader and make more again of what works and less of what doesn't. So now I just had a quick glance at the hour, at the clock. Okay, so yes, there's a very great question, really great question. The $1 million question is, run profits indefinitely or take profit at an R multiple? Again, this depends. So for example, in my trading, I tend to have partial take profits, which means there's, for example, depending on the market conditions, I aim to have a risk multiple of, in fact, you can see it here, payoff ratio is in fact, it's an R multiple, it's 4, more than 4 to 1. So which means I really try to see the market move strongly in my direction, and then based on that, it's not that I let it run indefinitely, but I try to take partial profits, which add up then to risk multiple, which is high enough to make sure that based on my win rate, I continue to stay profitable. I hope that this answers the question. But again, I think I already to some extent answered it, because I look at the time here. I think it's 9:25, so 1 hour ago. So I hope I answered it already. Based on several parameters like ATR, like sentiment extremes, like for example, also resistance, support lines you can draw on the chart, market research, you will find areas where it makes sense from a risk reward perspective, respectively from an expectancy perspective, to take profits. So yeah, I hope that this answers your question. And now let's move on to, even though we will probably just go through this here quite quickly, because if I continue to talk and talk and talk, I will have trouble to get everything around trading psychology made a topic. So in fact, it's something which is 100% theoretical. So there can be times, for example, once you see the market not moving in your direction. For example, you might say, I want to see a breakout to a certain level. Last week, for example, I had a trade in a plug, for example, and the news were very bearish. And so I expected really the market to sell off sharply, respectively the stock to sell off sharply. It's also given, for example, a component which is of interest, also something you can take into account when calculating risk reward. Let's say you have a stock you plan to short, there's a very bearish news, there's an accounting error, potential scam, which just happened, which didn't, at least not for now. It's not that this is a scam, but it's something you probably see at first glance and you ask questions later. So initially you pull the trigger and you reduce your position size massively. If you have a stock which went up parabolic and nearly vertical over the last year, well, and you have an institutional ownership of over 50%, you could imagine institutions now selling out the stock, which naturally results in downside potential for the stock over the day then. So that could be a massive down move here, in fact, which could be ahead of us. And thus, I'm probably not as aggressive with my profit taking as I would be in a market where I'm just scalping the momentum of the opening or something like that. So but coming back here to this example now, scaling out of trades. So it all comes down to our formula to make losing trades, in this case, short, or lose less than you initially planned. So which means that if I'm, for example, seeing that the market does not what I wanted to see and doesn't give me a direct feedback, I start to take out the risk out of a trade, all with the target to increase my long-term profitability in my trading, which means like you see a breakout, you say, if the breakout happens, I'm willing to risk, let's say, 50 points here. And I expect the market to move that quickly and that aggressively in my direction. If this is a true breakout with increasing volume here, that I'm out of the risk in seconds probably, can trail the stop to break even, have a free roll, and there we go, and just take it from there. Now, the thing is, if you see such a move happening and it's not increased volume and the market is like drifting lower, but drifting to new lows, breaking out to some extent, but not really taking on momentum, bearish momentum as you expect, and there's no volume increase, that's a sign that the market is telling you something. I'm not willing to break lower, aggressively lower here, which means then that it probably makes sense, if you see that, to take out size here, because you can always scale into the trade again. But it makes probably sense to say, hey, I'm taking out risk here. If I was initially risking, let's say 100 USD, I'm taking out 50 here because or reduce the position size, cut it in half, because the market is not giving me the feedback I wanted to see. Sometimes you will be wrong and the market moves with some delay strongly in your favor. Then you have to find a way to scale back in. But most of the time, based on my personal experience, usually this is a clear feedback from the market you shouldn't ignore. And taking out risk here is really adding to your overall profitability, even though not in just one trade or this one trade, but in the long run, you will see that I'm taking this feedback from the market seriously and not seeing what you want to see. That also is not just the price action, but it's also time-wise. So for example, if you know that, for example, your overall length of a trade, the duration of a trade is, let's say, 2 hours, and after 20 minutes, you see that the market is not moving in your direction. It's just dabbling around and there's no real momentum, which is moving the trade in your direction. And you've seen that pattern in the past, and you can show this based on your trading stats and based on your trading journal. It makes sense to reduce the position size, because that the market is not giving you the feedback you wanted to see after a certain amount of time is probably a sign that the trade is not going to work well for you, which means taking out the trade, you're scaling out of the position, and then again trying to add to your overall positive expectancy in the long run is what all this is coming down to, scaling out. So the other side of the coin here is an example I have here with a chart. I also want to go through quite quickly now. Scaling into a losing position is a common mistake. You probably heard about this. Scaling, or you pyramidize into a losing trade. You average your trade. What's the word for this? Don't averaging or something like that. So you're adding to a losing position. So that's what I'm talking about. And it's a common mistake among retail traders, because they say, well, now the market has to move slightly less aggressive in my favor so that I can take trade out, break even. So now the thing is, if you take this and adapt this to winning trades, well, it means that if I see a market moving in my direction, then usually I should take on more risk. Respectively, I should increase the position size. So that is the opposite sign here. And this is what we call then you scale into a winning position. And what you usually do once the market really shows a strong dynamic in your direction. So for example, I had an example I could show you right here now in the trade, but we will probably do this next week then in our sixth part of this power course, where you have this real example. But when I just saw that the market gave me a great entry And then I saw that based on my game plan, my second scenario played out while the overall thesis for the trade was still valid. And that was the moment then when I decided to say, okay, I add to my already winning position here by not adding more risk to the trade, but adding dramatically more in terms of potential and reward. And the trade played out really well. That was right in the first week of this month. And it made most of my monthly performance so far for the month. And this is exactly what scaling into winning trades then means. In fact, here, this is a common example of how you do that. So you start with your biggest position size, and then you build a pyramid in this case, and you start to scale into a position. Sometimes by saying, if I started out, let's say with 8 lots, then you add another 4 lots in this context, for example. So here in this case, it's a Euro USD example. So it's 4 mini lots with the test of the former lows. The market moves to new lower lows, is retesting this area again. You add to your initial 4 lots, 2 mini lots, and then you see the market here breaking, and then take out the profit in this area here. So, but it all comes down to you try to make more out of your winning trades, of your best setups, once the market gives you the feedback you wanted to see, while scaling out of positions aims to make your average losing trade smaller, since the market is not giving you the feedback you wanted to see. So it's not the best setup you're trading here, or it's not, it's probably the best setup, but it's not the market reaction you wanted to see, which will naturally happen. So take the feedback from the market. It tells you something. It's not working, at least not today. So you take out the risk here while you add to your winning trades then in this context. So position sizing, that was something we already made a big topic here during our initial open webinar on the Kelly criterion. So in fact, this is most of the content we already provided here in this context in the webinar. So I'm not really sure whether we need to go through this again. It's an intelligent way, let's call it, to find out what's the optimal position size. That's also, by the way, something you find here within this simulator. So I've included this already. If you put in these parameters, you see here, these are the input parameters, and this is what you get out of this. It's the output parameters. And there you have also this Kelly sign in this context. So a Kelly tells you, you should, if you have really a hit rate of 50% and a payout or payoff ratio, in this case of 1 to 2, or 2 to 1 in this case, so average winning trade to average losing trade, you should risk 25% of your account per trade, because your overall profitability is massive. Only problem is, let's assume we do this and we risk 25%. I will show you something what happens. So this is a crazy amount, okay? So you can't really see what's happening here, because here we are making so much money. You're the richest guy in the world, and this is what Kelly comes to, and this is what we also mentioned during this. You have here the biggest max drawdown trading that way, risking 25% per trade. It was 99.8%. So you're busting your account. Okay, so this is when you trade full Kelly and not adapting it to any means, but think of it as a pure theoretical construct. Doesn't make sense. It just busts your account. And in this case, I don't even know what the number is, but it's more than Jeff Bezos and Elon Musk have together in terms of net worth. I'm sure about that. So the average max drawdown you can also see here, and this is the average max drawdown, is 95.6%. So for a professional trader, this is not an option, as you can see. And this is one of the reasons. This is now in the real world, or at least here in the simulator, which shows you why you have to adapt when it comes to trade at least part of your portfolio with Kelly, and based on position sizing algorithms based on Kelly. So you can see that this Monte Carlo simulator leaves you very great opportunities to play around with these theoretical numbers. But I want to finish here with this very important aspect. If you take out something besides the formula around expected value for your trading in the future, especially if you trade and if you start with your trading right now, you wonder probably, when I open positions, and probably have not just one position, but several positions open, is this too big, or is it adequate here in this context? And the effective leverage, this formula, position size divided by your account size, gives you a perfect idea of whether you're currently over leveraged in the market, or if it's not, if you're not over leveraged in the market. And there's a rule of thumb. You can say that a position size divided by the account size. So if the position size, let's say, is 10,000 and you have 1,000 account, then the effective leverage is 10 to 1. And this rule of thumb is, in fact, exactly what you should look for. So if, for example, a player, in this case, it's a trader who plans to trade one lot, 100,000 units Australian dollar against US dollar, and your account size is 10,000, I'm sorry, not euro, Australian dollar, certainly, then again, the effective leverage is 10 to 1. And what I recommend you to do is, in fact, to trade with an effective leverage in your trading of max. I recommend even lower than that, of 10 to 1. Which means that you this is also something you can see here in this context. By the way, let me go back to this Monte Carlo simulation. If I say something like I have an average risk per trade of in this case 0.29, I can say that this is not giving you a clear idea of how much risk I take per trade, but my effective leverage in my trading is usually between max 3 to 4 to 1. So which means if I'm trading a 10,000 euro account, my position size does not exceed 30,000 to 40,000 units of the underlying currency or in this index or amount of gold I'm buying or stock and the value of stock. For example, I'm trading here. So usually my effective leverage is between 3 to 4 to 1. To give you a number directly from me, I just found out that I haven't included the numbers here, but I could also show you that the higher the effective leverage is, so the higher the position size of a retail trader is, the lower the chances that this trader will be profitable in his trading, bust his account in 80% of the cases, while the overall chances of being profitable increases to way above 50% once you have an effective leverage in your trading below 50, which probably answers to some extent also your question, how likely it is that I'm profitable in my trading. At least from an effective leverage perspective, with an effective leverage of 3 to 4 to 1, it's likely, highly likely, probably. And so this is the reason, based on my personal experience, why I recommend you to not risk more than 10 to 1 in your trading. And the effective leverage is crucial from a mental perspective. Too high, choose an effective leverage, for example, will naturally result in taking profits too fast and letting losing trades run. And this will have negative effects on your so-called payoff ratio. Why does this? This is what we will look at in the next presentation on trading psychology. If you want to take direct impact, or if you want to have a directly influence your effective leverage, you can do this in two ways. First one is position size of your trades, reduce it, or increase the size of your trading account. So these are the only two ways, in fact, to reduce the effective leverage in your trading. And so that brings us directly to the next agenda. But John, one question: Can I bring my coffee somewhere, please? At least for 2 minutes.